stop scrolling. What I'm about to show you in the next 18 minutes could be the most important financial signal you see all year. And I say that knowing how big that sounds. Imagine this. You wake up tomorrow morning. You grab your phone. You open your portfolio app. And Bitcoin, the asset that just got rejected at $73,000, has moved $10,000 overnight. Not because of Elon Musk tweeted something. Not because of some random influencer called a pump. But because something massive, something worth $3 trillion, just started moving through the global financial system. And the terrifying part? Almost nobody saw it coming. Here's what's even more unsettling. The signal that it was about to happen. It was there, hidden in plain sight, in the banking data, in the regulatory filings, in the on-chain numbers that most retail investors never even look at. So let me ask you this, and I want you to think about this seriously before you answer. Could the $70,000 level we're watching right now on Bitcoin be the exact line where the next massive move begins? Stay with me. Because by the time we hit the 9-minute mark, I'm going to show you something about institutional money flows that most financial channels are completely ignoring. And once you see it, you cannot unsee it. Welcome to the Wealth Continuum. Let's get into it. Let's get our bearings first, because context matters enormously here. As of today, March 6, 2026, Bitcoin is trading at approximately $70,000. Now, on the surface, that sounds like a round, clean number, almost boring. But here's what makes it anything but boring. Just weeks ago, Bitcoin touched $73,000. That was a significant level. That was a level analysts had been watching, traders had been positioning around, and institutions had been eyeing. And then, rejection. A swift, sharp pullback that sliced billions in leveraged long positions out of the market in a matter of hours. That kind of price action doesn't happen randomly. The market doesn't just casually push to a major resistance level, get rejected, and quietly pull back without there being a reason, a structural reason, a liquidity reason. And right now, what we're watching at the $70,000 level is one of the most important technical and fundamental confluences I've seen in years of covering this market. But here's the thing, and I want you to hold on to this thought. The real story might not be the price at all. The real story might be what's happening to the liquidity behind the price. Comment below right now. Tell me where in the world you're watching this from. I want to know if this information is reaching people globally, because what I'm about to explain affects every single country, every single market, every single investor, regardless of whether you hold Bitcoin or not. So why does the $73,000 rejection matter so much? Let me explain this in a way that actually makes sense. Not in trading jargon, but in the language of money and power. And when Bitcoin pushed towards $73,000, it wasn't just retail investors buying in excitement. The order flow data, the futures positioning data, and the on-chain analytics all pointed to something much larger, a complex web of institutional positioning that had been building for months. And then, simultaneously, something happened in the banking sector that most people completely missed. Analysts who track global capital flows started noticing unusual activity in bank balance sheets. Specifically, movements tied to upcoming regulatory changes, most notably, the full implementation of Basel III liquidity framework adjustments that are forcing banks across Europe, Asia, and North America to restructure how they hold and deploy capital. Now, I know Basel III sounds like something only a finance professor would care about. But stay with me, because this is where it gets really, really interesting. Basel III, at its core, is about one thing: liquidity. It's about making sure banks have enough high-quality liquid assets to survive a financial shock. And when regulators tighten those requirements, which is exactly what has been happening, banks don't just sit there and absorb it. They move money, they shift capital. They restructure their balance sheets. And here's the question that every serious analyst is asking right now in March 2026. Where does that capital go when trillions of dollars in bank balance sheets start getting restructured? Because here's what they're not telling you. When that kind of institutional capital starts moving, it doesn't just disappear into thin air. It flows somewhere. And historically, and I mean this with precision, historically, the assets that benefit most from global liquidity expansion are the ones with the highest risk-return profiles. You already know what asset class that is. But here's the part that almost nobody is connecting. Why would a Bitcoin rejection at $73,000 be linked to global banking regulation? That seems like a stretch, right? Stay with me until we hit the 9-minute mark, because I'm going to connect these dots in a way that will fundamentally change how you look at Bitcoin's price action. And when you see the full picture, you're going to want to share this with someone who needs to hear it. Let me take you back. Not to ancient history, but to moments that rhyme eerily with what we're seeing right now. In 2019, the Federal Reserve made a critical pivot. After a period of aggressive rate hikes through 2018, Chair Jerome Powell essentially reversed course. The Fed began cutting rates, it began expanding its balance sheet, it began injecting liquidity back into the financial system. What happened to Bitcoin? It went from approximately $3,200 in December 2018 to over $13,000 by June 2019. That is a 400% move in 6 months. Did retail investors see it coming? Some. But the ones who positioned early, the ones who understood that a Fed pivot meant liquidity expansion, and liquidity expansion meant capital flowing into risk assets, those were the investors who rode the wave from the bottom. Now fast forward to 2020, the COVID shock. The Federal Reserve and central banks globally unleashed the largest coordinated liquidity injection in human history. Trillions of dollars, euros, pounds, and yen flooded into the financial system within weeks. Bitcoin went from $4,000 in March 2020 to $69,000 by November 2021. Let me say that again. $4,000 to $69,000. That is not a coincidence. That is a direct, measurable, traceable relationship between global liquidity and Bitcoin's price. Now here's the FOMO moment I want you to sit with for a second. The investors who understood these cycles, who connected the dots between central bank balance sheet expansion, capital flows into risk assets, and Bitcoin demand, those investors didn't just survive those cycles, they transformed their financial lives. And the investors who said Bitcoin is too risky, who waited for certainty, who wanted more proof before they positioned. They watched from the sidelines, hit like right now if you don't want to be watching from the sidelines this time around. Because right now, in March 2026, we are potentially sitting at the beginning of another one of those inflection points. And the data, the actual verifiable, publicly available data, is starting to tell a very specific story. Let me tell you what that story is. $3 trillion. I want you to visualize that number for a second. If you stacked $3 trillion in $100 bills, the stack would reach from the Earth to the moon and back over 70 times. That's not an exaggeration. That is the scale of capital we are talking about. So where does this $3 trillion figure come from? It comes from multiple converging sources that analysts tracking global capital flows have been piecing together over the last 18 months. First, bank balance sheet restructuring under Basel III. As banks globally complete their Basel III compliance adjustments, estimates suggest that between $1.5 and $2 trillion in bank assets need to be reallocated, hedged, or repositioned. That process creates enormous capital flow pressure across all asset classes. Second, sovereign wealth fund repositioning. Multiple sovereign wealth funds, particularly in the Middle East and Asia, have publicly signaled increased allocation mandates toward alternative assets and digital assets. The aggregate repositioning from even a fraction of these funds represents hundreds of billions in potential inflows. Third, corporate treasury diversification. After the precedent set by early Bitcoin adopters in corporate treasury, more companies have been quietly diversifying away from pure cash holdings. The aggregate exposure across public companies alone has grown significantly since 2024. Add those three streams together, and you are looking at a potential 2.5 to 3 trillion in capital that is, right now, in various stages of being repositioned, reallocated, or redirected. Now, does all of that flow into Bitcoin? Absolutely not. Not directly, not immediately. But here's the mechanism that matters. And this is what you need to understand before I show you what's next. You don't need all $3 trillion to go into Bitcoin for Bitcoin to move violently. You only need a fraction. Because Bitcoin's market cap, even at $70,000 per coin, is approximately 1.38 trillion. Which means even a 1 or 2% shift in global institutional capital allocation represents tens of billions of dollars flowing into an asset with a relatively fixed supply. And what happens when tens of billions of dollars chase a fixed supply asset? You already know the answer. But here's what they're not telling you about this particular liquidity cycle. And this is the part that makes this moment genuinely different from every previous cycle. Stay with me. We're about to get into the most important part of this analysis. I want to slow down here and explain something that I think is genuinely misunderstood, even by people who follow crypto markets closely. The question isn't just, does liquidity affect Bitcoin? Because the answer to that is obviously yes, and most people with even a passing interest in markets understand that. The deeper question is, how does liquidity translate into Bitcoin price? What is the actual mechanical pathway? Because when you understand the mechanism, you stop reacting to noise. You start seeing the signal. Here's how it works. When global liquidity expands, whether through central bank policy, regulatory changes that free up capital, or institutional repositioning, the first thing that happens is that the cost of money drops. Borrowing becomes cheaper. Holding cash becomes less attractive. Yield on traditional safe assets compresses. When that happens, institutional capital, pension funds, endowments, family offices, hedge funds, begins its search for yield and return. It moves along a spectrum from least risky to most risky, and it does so in a relatively predictable sequence. Government bonds first, then investment-grade corporate bonds, then equities, then high-yield assets, then alternative assets. Bitcoin sits at the far end of that spectrum. It is, by design, by nature, by structure, a high-risk, high-return asset. And so, as liquidity expands and pushes capital further and further out on the risk spectrum, Bitcoin eventually becomes the destination for capital that has run out of yield everywhere else. This is not theory. This is the mechanism we watched play out in 2020, 2021, parts of 2023, and again in 2024, 2025. Now here's what makes 2026 genuinely interesting. And this is where I want you to really pay attention. In previous cycles, the liquidity expansion was driven primarily by one force: central bank policy. The Fed cut rates. The Fed expanded its balance sheet, full stop. What we're watching now is potentially a multi-force liquidity expansion. Central bank policy is easing in multiple jurisdictions simultaneously. Basel III restructuring is forcing capital reallocation. Sovereign wealth funds are actively repositioning. And on top of all of that, institutional demand for Bitcoin specifically has been institutionalized through regulated products that did not exist in previous cycles. Bitcoin ETFs, regulated futures markets, custodial solutions for institutional investors, these are all relatively new infrastructure pieces that essentially lower the friction for institutional capital to enter Bitcoin. Subscribe to the Wealth Continuum if you want us to do a dedicated deep dive on how Bitcoin ETF flows are specifically impacting price discovery, because that analysis alone could fill an entire video. But here's the thing, something unusual is happening in this current cycle that I haven't seen discussed anywhere else. And it's what I've been building toward this entire video. Stay with me for the next 2 minutes, because this is where it gets really concerning, or really exciting, depending on which side of this trade you're on. Here it is, the hidden signal that traders and on-chain analysts have been quietly discussing for the last several weeks. When Bitcoin got rejected at $73,000 and pulled back toward $70,000, the headlines told a story of weakness. Bitcoin falls. Crypto pullback. Bear market incoming. But the on-chain data told a completely different story. Here's what was actually happening beneath the surface while retail sentiment was turning negative. Long-term holder accumulation was accelerating. On-chain metrics. Specifically, the supply held by addresses that have been inactive for over 1 year were showing a consistent increase even as price was pulling back. In other words, the investors with the longest time horizons, the ones who have held through multiple bear markets and volatility cycles, were not selling. They were buying. That is a significant divergence. Price goes down, weak hands sell. That's expected. But when strong hands use that weakness to accumulate, that tells you something important about where smart money thinks this is going. Second signal, exchange outflows. The amount of Bitcoin being withdrawn from centralized exchanges, moved from exchange wallets into private self-custody wallets, has been elevated in recent weeks. When investors withdraw Bitcoin from exchanges, they're not planning to sell it quickly. They're planning to hold it. That reduction in available supply on exchanges historically precedes significant price moves. Third signal, derivatives, market positioning. In the options market, there has been notable accumulation of long-dated call options, specifically contracts targeting price levels of $80,000 to $100,000 in the Q2 and Q3 2026 timeframe. Now, options positioning alone doesn't predict price movements, but it tells you where sophisticated market participants are placing their bets with real money. Now, and this is the important part, none of these signals are guarantees. Markets are complex. Signals fail. Anyone who tells you they know exactly what Bitcoin will do next is either lying to you or lying to themselves. But here's the question I want you to think about and answer in the comments. If long-term holders are accumulating, exchanges are seeing outflows, and sophisticated options traders are positioning for higher prices, what does that tell you about where the informed money thinks this goes? And more importantly, what does it tell you about where the $70,000 level fits into the bigger picture? Because some traders, and I mean serious, institutional-grade analysts, believe that the $70,000 level is not a ceiling. They believe it's a floor, a launching pad, the line where the next big move begins. But here's the tension, and this is where it gets genuinely fascinating, because there's another scenario that we have to take seriously. You need to understand this before I show you what's next. Let's talk about scenarios, because intellectually, honest analysis doesn't just tell the bullish story, it forces you to confront the bearish one too. And understanding both is what separates investors from gamblers. Right now, everything in the Bitcoin market revolves around one number, $70,000. This level has become the line that could determine what the next phase of this cycle looks like. So let's walk through the two scenarios. Scenario 1, Bitcoin holds $70,000. In this scenario, 70K becomes strong support. Every time price tests it and bounces, it confirms something very important. Buyers are stepping in, accumulation is happening, and the broader bull structure remains intact. And if the massive global liquidity shift that analysts are talking about, potentially trillions of dollars moving across financial markets over the next few quarters, begins to flow into risk assets, Bitcoin sitting above 70K could become an incredibly powerful launchpad. Historically, Bitcoin has done this many times. A sharp rejection from a local high, followed by consolidation above a key psychological level, and then a powerful continuation of the uptrend. If that pattern repeats here, the next major levels analysts are watching are $80,000, $88,000, and then the psychological milestone, $100,000. But that brings us to the second scenario, and this one is a little more uncomfortable. Scenario 2, Bitcoin loses $70,000. If Bitcoin breaks 70K convincingly, not just a wick, but a sustained move below it, the technical picture changes quickly. In that case, the next major support zones analysts are watching sit roughly between $62,000 and $65,000. And below that, a deeper support level around $58,000. Now here's the key point. A correction like that would not necessarily invalidate the long-term bull market. Bitcoin has experienced 30 to 40% corrections even during major bull cycles. But what it would do is shake out leveraged positions, test investor conviction, and potentially delay the timeline for the next major move higher. It would also force analysts to reconsider the timing of the large liquidity rotation narrative. Maybe the capital is coming later, maybe markets priced it in too early, or maybe macro conditions temporarily slowed the flow. And this is where psychology comes in, because here's the truth about every major Bitcoin move in history. Before it happened, it always looked confusing. The news was mixed, analysts disagreed, signals were contradictory, and there was always a convincing argument for why now isn't the time. In 2020, the argument was, we're in a global pandemic. Why would anyone buy Bitcoin? In 2023, it was, crypto credibility is destroyed after exchange collapses. In 2024, it was, Bitcoin already ran too far, wait for a pullback. Every time, the people who waited for perfect certainty missed the move. And now, here we are in March 2026. The current argument is, Bitcoin just got rejected near 73K. Markets are uncertain. Maybe now isn't the right moment. Maybe that's true. Markets can always go lower. But here's the important thing to understand. The people who capture the biggest moves aren't the ones who waited for certainty. They're the ones who recognized the signal early, before the crowd did. Let's bring this full circle. Imagine waking up tomorrow and seeing Bitcoin move $10,000 overnight. For most people, that move would feel like it came out of nowhere. But for investors who were watching the macro signals, liquidity shifts, capital flows, institutional positioning, the pieces were already there. Right now, the market is sitting at a crossroads. Bitcoin around $70,000, a fresh rejection near 73K, and a growing narrative about a massive global liquidity shift. Two very different scenarios are possible, a continuation toward 80K and beyond, or a deeper correction first. What matters isn't predicting the future perfectly. What matters is understanding the possibilities before the crowd reacts. So now I want to ask you, do you think Bitcoin holds $70,000 and pushes toward new highs? Or do we see a deeper correction first? Comment your answer below and tell me where in the world you're watching from. The global perspective on this market is incredibly important. If you found this analysis valuable, subscribe and turn on notifications. Because in the coming videos, we're going to break down institutional capital flows, global banking regulation, and how they could shape the next phase of the crypto market. The $70,000 line is being tested, the $3 trillion liquidity question is on the table, and the next few weeks could be extremely important. I'm watching closely, and now, so are you. See you in the next one.